Hi guys, welcome back to the channel. My name is Dave and I often get asked the question, where should I start investing? Meaning, what should I buy first? And I often point to the S&P 500. Products like VOO, IVV, or SPLG. It's all the same thing. Very low cost ETFs that you can buy, dollar cost average into every single week and grow your wealth. It does a great job. It's a great place to get started. But is there anything better out there? And there are, but it does add a little bit of additional risk. But when you see these great returns, it's hard to ignore. So we're going to look at one of those today. If that is what you're looking for, please stick around. Boop. So if you simply lump sum invested into the S&P 500 at the beginning of 2023 with a product like VOO, you would currently have about a 39% return on that money. That's outstanding performance over the last 18 months. Nobody can argue that. However, during the same time period, I'm looking at an ETF here that's returned over 72%. Outstanding. And it still has a broad-based group of stocks. So is this a better option for us than to just invest into the S&P 500? We've got a long track record here to look at. Does this product trim out the fat that we no longer need based upon what we have going on in the world around us? Is it safe to do so? That's what we're going to look at. My answer is perhaps. And I know what you're thinking. Just tell me the name of the damn ETF so I can go eat my Cheerios and watch Family Guy. But that's not how YouTube works. I got to keep you in suspense. So suspense over. It's SCHG from Schwab. It's been kicking butt for about 10 years over the S&P 500, doing a great job. And now we're going to take a look at it on Seeking Alpha. By the way, I am a Seeking Alpha affiliate, and there are affiliate links down below. If you like what you see here, feel free to use those to sign up. There are some nice discounts in there. So if you're looking for something to do stock research, stay up on the latest news on a particular stock or ETF, I really do like Seeking Alpha, and it's something that I use myself. So SCHG is the Schwab US Large Cap Growth ETF, and you can see the 1-year performance. Pretty darn good, about 40%. The expense ratio is very low, almost in line with a standard S&P 500 index ETF at 0.04%. Quite tolerable. I appreciate that. Yield is quite low, so you're not going to have a bunch of monthly yield paying you out every single month. That's not why we want to own this. We want to own this for the growth. SCHG, the G is for growth. It's got $28 billion of assets under management. It's a fairly large fund. If we run over and we can take a look at the holdings. First, let's look at the holdings breakdown and just understand that we have 250 different stocks in here. So it's still pretty darn diverse. It's not the S&P 500 with 500 different stocks, but it's got about half at 250, with technology being the largest section by far at 47%, then communication, healthcare, consumer cyclical, and financials following that up. And if you go down to the bottom, you're going to find a lot of the popular stocks that have been driving this market for so long, like Microsoft, Apple, Nvidia, Amazon, and the rest of the Mag 7, along with Broadcom, Eli Lilly, and Tesla. And again, there's that 250 different holdings that you see there. And yeah, as I mentioned in the opening, versus VOO, which is one of the more popular S&P 500 ETFs, you can see that over the last 18 months, since the beginning of 2023, we've got about a 39% return for VOO and a 72% return for SCHG. And that outperformance of large cap growth in the United States has been there for a long period of time. If we look at the total return of SCHG versus VOO, year to date, we see a 14% gain versus 11. If we go out 1 year, we're going to find 40% versus 29%. If we go out 3 years, we see 43% versus 33%. We can continue. Let's go out 5 years, 141% to 100%. How about 10 years, 340% versus 233%. So it does beg the question, do we need to clean up the S&P 500, get some of those stocks out of there, maybe some of that dead weight, and just focus on large cap growth in our portfolio as the core of our portfolio? So now that we have that basic understanding, let's try to understand the fund's goal, which is to track as closely as possible before fees and expenses the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. And the criteria for inclusion in SCHG is based upon things such as the PE ratio, price to earnings ratio, the projected earnings growth, the price to book, the dividend yield, trailing revenue growth, and trailing earnings growth. Out of a total of 750 stocks that fit this criteria, they take the 250 best, they use market cap weighting, and they rebalance every single quarter. Large caps have been outperforming small caps going back several years. Just check out this chart. Will it continue? That's the real big question. It certainly seems that way unless we see some kind of substantial change, maybe fiscal policy that slows down mega cap stocks such as the Mag 7. However, it is an election year, so who knows, right? Growth at the moment just doesn't seem to be slowing, and value certainly doesn't seem to be catching up. While I love my value stocks, if we look, let's say, a side-by-side comparison of SCHG and Mystery ETF here, also from Schwab, shows a vastly different basket of stocks that have underperformed. Now, this ETF is SCHD, which is a solid product and one that I own and one that I've talked about a lot on this channel. The value can clearly be seen in some of these top values, such as PE ratio and price to book versus the rich products that you get over here in SCHG. But the growth values that include 5-year earnings growth that is more than double that of SCHD is what continues to propel SCHG higher. And at some point, it has to stop, right? Maybe, maybe not. When I do go searching for individual stocks, my tendency is to gravitate to value, and I'm drawn to this side over here. But time and time again, it's the other side that outperforms. And those that take the risk are certainly reaping the reward. Interestingly enough, if we backtest a combination of 50% SCHG and 50% SCHD, it also pulls ahead of the S&P 500 over the past 10 years, giving you an extra bit of return with similar volatility. And perhaps that's something else worth exploring a little deeper. Now, after checking out SCHG, I do like this ETF. I think it's a good, solid option. Great historical performance, and of course, there are always going to be alternatives to go along with it, so some others to check out or to consider compared to SCHG would be VUG from Vanguard, SPYG from Spider, and IWF from iShares. All of these have performed quite well, and they've been around for over 10 years, but still, slight outperformance sneaks out the win, SCHG. And also, if you're looking to pair this SCHG with a value play, you might stay with Schwab because SCHV is built to have zero overlap with SCHG. So that gives you a nice Chianti to go with these fava beans. So SCHG is certainly a solid product with great historical performance. Does it offer you enough diversity to be your core holding? Let me know what you think down below. And if you like this type of thing, like and subscribe. I appreciate you watching, and we'll see you next time. Take care. Whoop.